Okay, good afternoon. We're going to get started now. I do appreciate your patience while we waited for a few more people to get hooked on so that they didn't miss any part of this. Again, my name is Scott Tillesen. I'm Vice President of Credit and Customer Care for Tech Data Corporation in the Americas. Maybe I should explain what the customer care side is. In addition to the credit function, the extension of credit and collection of accounts receivable, the team that I'm responsible for also is involved with the authorization of returns. So return authorizations and the handling of customer issues is handled by a team that's part of my group. We're headquartered in Clearwater, Florida, and it's my pleasure to be with you this afternoon. I was asked by Greg Banning and Doug Young to put on this presentation and to share with you some of the things that we've learned over time in dealing with literally tens of thousands of technology resellers. What works, what doesn't work, how you can navigate the credit arenas, find financing alternatives, grow your business, and become more profitable. And so those are the things we're going to be chatting on today. I believe I have your phones on mute. If you don't, if that's not the case, please put your microphones on mute if you can figure out how to do that. This session will be recorded, and it's going to be available for you at a later date to replay if necessary. Direct any questions that you have. We won't have questions and answers actually during the webinar, but direct any questions that you have back through Greg Banning or Doug Young at ASCII, and they'll definitely get back with me or perhaps handle your questions directly. So let's get started. So as I mentioned, let me go through here. Today we're going to be talking about, in a broad sense, financing alternatives as well as cash flow. And again, the Tech Data does business with tens of thousands of technology resellers in the United States each year. And over time, we've seen what works, we've seen what doesn't work. And when I speak to you today, I'm going to try to speak to you not as a representative of Tech Data. It's not as important to me that I pitch Tech Data to you as important as it is for me to just provide you with the kind of input and guidance on these matters that might not otherwise be available to you. So I'm going to try to be agnostic. From time to time, we'll touch upon things that are unique to Tech Data, but in large part, what I'm talking about would apply to your relationship with any distributor, any supplier, and it's going to be pretty much agnostic. Okay, so I'm going to have one little short accounting lesson because it's be difficult to talk about this if we don't have a few fundamentals in mind. And so the first part, what we're going to do is I just want to chat about balance sheets, what a balance sheet contains, and what it's all about. So on the left side of the balance sheet, typically in a typical presentation, what we're looking at is the assets of a corporation or a company, or even a sole proprietorship or partnership. It doesn't make any difference what form you are. If you keep books and records, financial records, you're going to have a balance sheet. And on one side of the balance sheet are going to be your assets, things like cash, accounts receivable, fixed assets. That would include computers, automobiles, trucks, office equipment, all of that stuff. And in some cases, intangibles. And the intangibles might be related to things like acquisitions, goodwill, etc. There's a number of classifications, but the important thing to know is that the assets are shown on one side of the balance sheet. On the other side of the balance sheet, despite their titles, is the financing side. So the assets, the total amount of assets equals the total amount of financing. Financing can come basically from three sources, and we're going to get into what those sources are. But the basic concept here excuse me while I silence my phone. There we go. The basic concept here is that for every dollar of assets that you add to your balance sheet, you need to add a dollar of financing. So as your business grows and as you add assets, you have to have a place to obtain the financing. And the financing can come from three sources. It can come from suppliers, and that's the credit limits that your suppliers, provide you to make purchases on credit. It comes from banks and finance companies in various different forms. And then it comes from shareholders. Those are the three sources of financing. And of course, from shareholders, we're talking about not only the original equity infusion to begin the company, but any profits that have been earned along the way, less any distributions that have been, or losses that have been incurred along the way. But that's the shareholders' investment. And that's of particular importance when creditors view your books and records, and we'll talk more about that a little bit later. But the important concept here, every dollar of assets requires a dollar of financing. As you grow the business, as you add inventory, accounts receivable, more screwdrivers, more delivery trucks, more desks, more computers, every time you add assets to your company, you need a place to obtain financing from. You need to know how they're going to be financed before you start to acquire them. You need to know where that financing is going to be derived. You have to have those financing sources all aligned. The time to go looking for financing is before you need it, not 5 o'clock on Friday, but well before you need it. And I can give you some tips as to how to go about doing that. Now, there's no magic formula to say exactly what proportion all these financing sources should be in. But successful companies use all of these sources. And I frequently have customers come to me and say, hey, Scott, I don't want to use a bank because banks charge me interest. And my response to that is Fortune 500 companies all have banks. And there's times that customers come and say, I want more credit from you, my distributor. And I say, you don't have enough investment yourself in your business. Now, the best example of what I'm talking about when we talk about equity is to just look back at some of the biggest technology companies, the Dell computers of the world, the Microsofts, the Apple computers, and even Tech Data for that matter. At one point in time, those companies had one investor, one equity shareholder, or two. And today they have millions. And why is that? At some point in time, those companies, in order to grow, needed more equity than the shareholders could put in themselves in order to entertain creditors and grow the business. And so that's an important concept. But let's keep in mind there's three sources, and we're going to, again, talk more about this as we go through. Okay, so how to get more financing from your suppliers. Suppliers practice what I call the art of credit, not the science of credit. There's very little direct correlation between modeling a business and really understanding the business. So there's a certain dose of understanding and relationship that goes into credit decision making, and I'm the first one to admit to that. However, there is a limitation as to what creditors will offer. Sharing financial statements is always a very, very good start. They ought to be timely, they ought to be well detailed, ideally prepared by a third party. That adds a little bit of independence in the preparation, a little less bias. Creditors like financial statements. Having a good payment record. Thing you need to know is that there is a sharing of payment experience in this industry and in most industries. So if you do something to one of your suppliers, there's a very good chance that other suppliers are going to know what your payment behavior is, and it may affect the amount of credit that you have extended. So keep that in mind. Lien suits and judgments. Again, information readily available by data aggregators out there. The Dun & Bradstreet reports, the Experian, the Cortera reports, I can name a few others. They go out and publicly capture all this public information and report it to people who have an interest in you. And so it's really important that you keep your record clean of lien suits and judgments. Letting people know about the education and experience of the owners and operators is very important. And you can do that in a variety of ways. One way is to have that information on your websites. Now, I know you all have websites, and I know why you created those websites, and that's to entertain customers. The thing to keep in mind is that creditors are also looking at your websites in order to find out more about you. So use that opportunity to share information about your, again, the education and experience of the owners and operators, and it's an easy way to do it. Another way to do it is just to keep a distribution list of your creditor contacts from your suppliers. And when you have something to share about the company, you can share it that way, or a data sheet. There's lots of ways to go about it. You can provide a personal guarantee or a security interest. It's sort of a public filing, a lien against your business. You can do that, and that will frequently get you more credit. Entirely appropriate. I can tell you that today, Tech Data holds about, I think by last count, close to 17,000 personal guarantees that we receive. So definitely a way of getting more credit. However, my advice to you would be never, never, ever give your personal guarantee or any other form of security unless you know exactly what you're going to get for it. So if someone is already giving you X amount of credit and you want more credit, don't give them the personal guarantee unless they can tell you, in exchange for your personal guarantee, at least initially, this is the amount of additional credit that I can give for you. So know what you're going to get. You could provide a standby letter of credit. That's a bank guarantee. If you're not familiar with this, I'm sure your local banker would be happy to explain what it is. But essentially, you arrange through your bank to provide a payment guarantee to your supplier. And your supplier will typically reward you with a minimum of 1-to-1, $1 of additional credit for every dollar that standby letter of guarantee is issued for. So let's say that standby letter of credit is issued for $25,000 and has a term of 6 months. That means you can go out from a supplier, buy $25,000 worth, pay them in the normal course, buy another $25,000, pay them in the normal course, and do that repeatedly over the life of the standby letter of credit. It's a very, very inexpensive way to obtain additional credit, actually much cheaper than borrowing the money directly. So something to consider. And the last thing is communication. Suppliers like information and timely communication. And what the creditors like to say is that bad news is better than no news. If you have bad news, it's very likely that you're going to be able to disclose what the remedy is for that bad condition that you're disclosing. If you don't share anything at all, and there is bad news that you're hiding, once your creditors find out about that, they'll never forgive you. So you'll never be trusted again. And it will likely affect the amount of credit that you're extended by those creditors. Okay, you can also use the strength of your end users to get you more credit. At Tech Data, we call this an assignment of proceeds. In other words, your end user commits to you a purchase order for something. You issue that purchase order to Tech Data. We supply the products for that. But before all of that happens, you get a short document prepared on your letterhead, and you have the end user agree to pay Tech Data directly. Now, if your end user is of any pedigree at all, if they're certainly Fortune 1000, state and local government, end users, et cetera, that's definitely a way to go. And on large transactions, and even I would say small transactions, stay down to about $25,000. Definitely something to consider. We have 2 people who work full-time doing nothing but these kinds of transactions. And I can tell you, we had a customer who came to us a few years ago with a transaction to replace every printer in every Home Depot store. That was a $6 million transaction. It was a 2-person business working out of the basement of a home. And we were able to provide the financing because we were able to get direct payment from Home Depot. We don't become part of the transaction. Purchase order is still issued to you. You do the billing. It's just where the money gets redirected. And we pay ourselves first, and then we pay you your profit, your services, your sales tax, whatever else might have been in that remittance that we received as part of the transaction. Another way to get more financing is to encourage your end users to lease the products that you're trying to sell to them. And we can introduce you to one of our leasing partners. And what happens is before that transaction gets shipped, we can arrange for a split funding agreement between us and that leasing partner. So what that does is the leasing company would pay Tech Data directly for our part, and then they would pay you directly for your part being services, profit, and sales tax, and anything else you happen to sell the end user as part of that leasing scheme. So definitely something to consider. We do a lot of leasing as well. Now, when we talk about shareholder investment, the thing to keep in mind is creditors are looking at the size of the owner's investment in their businesses as compared to the amount of credit that they're being asked, that's being asked of the vendor. Again, no magic formula there, except to say creditors like to see that you have skin in the game. If you have only $5,000 invested in your company, and then you go out asking a supplier to provide you with $50,000 of credit, there's a good chance that they're going to say you don't have enough skin in the game. It's uncomfortable for an unsecured creditor to have more credit extended than the owners do in their own business. Again, let's go back to the Dell, Microsoft, Apple, Tech Data example, where at one time there was one shareholder with a certain amount of investment, and now what we're seeing is at certain points of time in the different companies' histories, they had to go out and bring in more equity by selling shares of stock to other shareholders. So if this is the way you want to grow, you can do it privately by just arranging for additional shareholder investment. That's mother-in-law, brother-in-law, sisters, and friends, or go to the public, whatever is appropriate for your business. But Fortune 500 companies have all sought that outside investors, to enable their growth. Now, sometimes you're gonna need bank line financing. And let me just start by saying, when creditors look at you as a credit risk, one of the things that they want to see is that you've had the maturity to pursue all of the best business practices that is expected. And one of those is your ability to go out and obtain a bank line of financing. Merely the act of getting to your bank and arranging for this is comforting to creditors that have the know-how and have taken those steps. Now, you may not need that bank financing immediately, but you might need it on occasion if your overhead spikes or your overhead leads your remittances from your customers, or there's a gap between the time that you need to pay your vendors and the time that you receive payment from your customers. And what we like to say is that it keeps creditors happy at a very minimal expense. If you disappoint your creditors by not adhering to the terms and conditions of sale, again, creditors have long memories. They're going to hold it against you. And one way to avoid that is have the bank line of financing in place that allows you to close that gap between accounts payable and accounts receivable, or accomplish whatever other business needs that there might be coming up. Now, we're going to talk about cash flow financing, cash flow management, cash flow forecasting at the end of this presentation, but this sort of feeds right into that. It's an important element of cash flow forecasting. Now, you can go to Joe's National Bank, where you live and where you bank, and you can ask them for financing. But another way to get financing is to go to a technology financing partner. Now, we have some at Tech Data. Other distributors also have some. We share some. Let me tell you how that works. So instead of going down to Joe's National Bank, what you would do is you would go. Someone has their microphone on. If you could mute that, would appreciate it. Thank you. So some of the talking about the way you go about this is, instead of going to Joe's National Bank, you go to one of these technology lenders and you apply and obtain a line of credit with them. Now, one of the first things to point out here is, unlike Joe's National Bank, when you go down there and you try to tell them, explain to them what business you're in, there's a good chance that 3 months, 4 months, or 6 months later, you're still going to be attempting to explain to them how the technology channel works and what your role is in it. If you go to one of these technology financing partners, this is all they do. And they typically can make their decisions in 48 hours, sometimes in 24 hours. So if you want a quick answer and you want more credit, definitely consider going this way. Now, once you have that credit line in place, and let's say I'm going to use GE Capital as one of those sources. So let me say that. So if you go to GE Capital and you set up a credit line with them, now you have an order to place. When you place the order with Tech Data, whatever way you typically place orders with us, you would designate that you want that particular order to go on your GE line of credit. When it does, we flag it in our system. That order then goes out to GE, gets authorized by them, goes to the warehouse, and gets picked, packed, and shipped. The finance partner will then pay Tech Data. We like that, of course, because we like being owed by GE Capital more so than we typically do a typical reseller. With GE Capital's, very big, very stable. So we like that. We get paid by Tech Data. You pay GE Capital, but the important thing to consider here is that this financing is coming to you free, and it's free typically for 30 to 60 days, depending upon which financing partner you have and what products you're purchasing, but a minimum of 30 days free financing on everything that you would buy from a Tech Data. And again, other distributors offer similar offerings, not exactly the same, but similar offerings, and so it's not unique to us. In fact, again, I'll share with you that if you were to set up a credit limit with GE Computer Distribution Finance, or GE Capital as it's also known, you could take that financing and also have it open and available to use with other distributors. We hope that you would only use it with us, but the thing to know is that it's usable with most other distributors as well. So definitely something to consider. GE Capital, Wells Fargo, Delaga Landon, and IBM Global Finance are four of our partners. Okay, so we've talked a lot about typical financing and what it takes to entertain creditors and how to get more financing and different forms of financing. But all of this would be for nothing if we didn't really talk about one of the real fundamentals of business management, and it all centers around cash flow. If we look at the reasons why businesses fail, almost universally and exclusively, we will find that it's failure to manage and forecast cash flow is why businesses fail. So let's talk about the management side of cash flow. So again, sort of forget everything that you learned in school or someone taught you about accrual-based accounting. This is not accrual-based accounting. This is real cash flow. This is money when you put it in your bank. It's money that you take out of your bank. And it falls into two categories, outflows and inflows. So talking about outflows, one of the primary sources, I presume, of your outflows is going to be accounts payable, for example. Salaries would be another. Rent would be another. You get the picture. In the case of accounts payable in particular, one of the things to know about that is that you really need to know what your suppliers' processes are, what their expectations are, and how they mesh with your processes. So if you only cut checks on Fridays, your suppliers need to know that, and you need to know what your suppliers' expectations are. If you cut checks on Tuesdays, or if you cut checks every day of the week, if your supplier is expecting you to remit your payment with a certain amount of detail that's going to enable them to keep their books and records clean on you, you need to know what that data remittance detail their expectations are. You need to know what your options are in advance, and that means that if you'd like to, and I encourage you, good business practice is talk to your suppliers and find out how slowly you can pay them, and determine that in advance. But keep in mind that the terms that you ultimately use need to be mutually agreed to. Don't wake up on Monday morning deciding that you're not going to pay your suppliers. Creditors, as I've said before, have long memories, and once they're disappointed, you then become less trustworthy, and that will ultimately affect how much credit they're able to provide to you. But good practice is negotiate better terms if you can, and by talking to your vendors. Now, on the accounts receivable side, that requires some management as well. That would be one of the key inflows. So it all begins with a strong credit application. And what do I mean by that? When you have if you set up business, if you start to do business with someone and you have an application form for them, it really needs to contain more than just gathering up their name, address, and phone number. What you need is a certain amount of terms and conditions of sale. For example, if you look closely at the fine print, I'll admit, on the tech data credit application, you'll find that amongst the terms and conditions of sale are that the agreement is subject to Florida laws. And if we have a dispute, it's going to be remedied in the courts of Pinellas County, Florida, because that's where we are, and it's convenient for us. If we end up with a dispute that requires tech data incurring any out-of-pocket expense in order to resolve that dispute, that's going to be added onto your bill, and by virtue of submitting that application and signing it, you've agreed that to pay any of those additional expenses, and so we have a right to obtain those in a court judgment. So a strong credit application, it can do many, many things for you. The ability to collect late fees and late charges, it would be another. But make sure that your customers have a clear understanding of what your terms of sale are. Analyze your customers, make sure they're credit worthy, follow up on them carefully and consistently for in the collection process. So let me put a little emphasis on that as to what works and what works very well. Number one, consistency in collections. If someone goes past due and you typically call them on the first day, if you change your practice even once and call them on the 15th day after they're past due, all of a sudden they're going to start waiting till the 15th day before they start getting nervous. So consistency in your practice is important. Typically people will come up to me and ask, well, what's the best time to start the collection effort? My answer is always the day that you deliver the product or complete the service. That's when you start your collection. That's when you ask your customer, did everything arrive? Was it put in the right way? Did we live up to our expectations? And then ask the question, is there any reason why you won't be able to pay us according to the terms and conditions of sale that we agreed to before I perform the service or delivered the product? So start it early. Don't wait until it's past due to find out that the customer isn't paying you $100,000 because you were one 6-foot cable short of satisfying them. Find that out very early. So the first part of this was consistent collection process, start early, but consistent process. The other is an escalation route. You need to have a route of escalation. So you may start with a phone call, you may follow it with a letter, but at some point you need to even do more. And that would be to maybe refer it to a collection agency. And if you don't know who they are, Google them. There's plenty of them out there, and they can speak for themselves. But we use them here at Tech Data. All distributors, most big companies do. And so we have a route of escalation, and at a certain point, we put it in the hands of a third party and let them try to do the collection. Typically, they're more effective. Okay, so you get the idea. We have outflows and we have inflows that need to be managed. And we could talk about other elements of outflows and inflows, but you get the idea by these examples. There's ways to manage. And what you're trying to do is you're trying to get that cash flow, the inflows you want in sooner, the outflows you want out later. That's the whole theme. Now, all of that management is no good if you don't use the information properly. And the information goes into your forecast. And so what I would advocate is you need to do cash flow forecasting. You need to identify the amount and the sources, the inflows and the outflows of cash as they're going to occur in periods of time going forward. And how far forward? Well, the people who are really good and professional about this say that the best way to do this is to look out at least 13 weeks, one quarter of a year. But you do that every week. So every Monday morning, say, you look out 13 weeks as to how you see your inflows and your outflows occurring over time. You have a cash balance today, and over time, it's going to be increased and decreased by the inflows and outflows. But at some point in time, you may see that you run out of cash. And that's the reason for looking out into the future at least 13 weeks. Because presumably, you'll have at least 13 weeks notice to discover that you've got a problem that's going to occur. And hopefully, you'll have time to remedy that problem by better managing the cash flow or looking for sources of cash that you might bring in that weren't in your original forecast. So that's how it's all done. Now, you can hire MBAs from Harvard and Yale and Wharton to come in and do this work for you and do it in a very sophisticated way, or you can literally do it on the back of an envelope. And what I'd like to show you is a simple Excel spreadsheet model here, and to give you an idea of what I'm talking about and how the simplicity that it can be in, and it's very easy to understand. So on the top part here, and let's see if my mouse appears here. So I'm circling that assumptions area right there. So if we're talking about, these are the non-cash assumptions. You make sales on credit. You make purchases of inventory. And this is a forecast of what those are going to be. And that's only to give you some guidance in order to plan when, looking down here in the info section, when the accounts receivable are going to be collected and when the accounts payable is really going to be paid. Now, what I've done here is I've included, say, in the outflows, salaries, sales taxes, rents, loan payments, travel expenses, some items. You don't have to detail every nickel. You can lump in the smaller stuff together. But definitely you'll want to call out salaries, bonuses, rent, things like that, just to make sure you don't miss them and that you have them in. And then what you look for is going down to the bottom. You begin with a cash balance. You have the cash flow for that period. In this case, it's a negative $1,400. Brings you down to a new total of $3,600. Now, the next week, it's going to be a negative cash flow as well, bringing you down to $2,500. Finally, out here, we have in week 4, we have a positive cash flow. It brings your cash balance back up, et cetera, et cetera. This particular model does go out 13 weeks. I'm just showing you the first 9 for an example. Now, you're going to make mistakes. It's hard, if you think it's hard to forecast 13 weeks out, it's almost just as hard to predict what's going to happen next week, and I understand that. But this will provide you with really great guidance and show you where you need that extra cushion in order to overcome a problem that might occur that you haven't forecast. But anything that you forecasted, you most definitely need to have a remedy for that. Otherwise, it's going to be a problem that's going to be detrimental. Now, who's affected by cash flow? Well, you can easily disappoint a lot of audiences. You can disappoint your suppliers, your landlord, your employees. You can disappoint the owners who might be expecting distributions, et cetera, et cetera. You know, it's endless. And you don't even have to disappoint all of them. If you disappoint one of them, you know, potentially it's life-threatening for the business. And again, I think creditors will universally agree that when we diagnose, you know, what is it that causes businesses to go out of business, it's a failure to forecast cash flow. Sometimes that cash flow forecast will tell you that you've reached the end of the life of the business. Sometimes there are no remedies, but better that you know that rather than burn up a lot of money trying to fix something that maybe isn't fixable. Now, I hate to be discouraging about that, but one of the things I do, questions that I ask when I give presentations, is I say to the audience, very quickly tell me the names of all the companies that are over 400 years old. And then I say, how about 300 years old? How about 200 years old? Really, until you get down to about 100 years old, you can't come up with many examples. And even at 100 years old, it's only a handful of railroads, a few retail stores, and a couple of universities and newspapers. But there were 1 million businesses, 200 years ago. Why aren't they all in existence today? Well, technology changes and obsolescence occurs. Owners and operators become disinterested. And again, it's just the evolution of products. Buggy whips aren't in demand. Horseshoes may not be as in strong demand, etc. And so businesses change. Fires and floods and natural disasters take businesses off the map. So there's a lot of reasons why businesses don't continue to exist. But there's a lot of businesses. Most businesses fail, not because of those reasons, but because of the owners and operators' failure to manage properly cash flow and to forecast it sufficiently in advance to remedy the problem in time to keep it from being life-threatening. So if you sense my passion about the subject, I'm glad, because to me this is really the keystone of business management skills, and I encourage you to consider doing this. If you like the simplicity of this Excel spreadsheet model, you're welcome to it. And I'm going to give you a website that you can find that information at on the last slide. But let's just go back one more time and talk about what we've talked about in the session this afternoon. So we said, hey, you can get additional financing from your suppliers, but you need to entertain them. One way is by financial statements. One way is by certain forms of security, by making your payments on time, etc. You can use your end user's creditworthiness via the assignment of proceeds approach or split-funded leasing. Those are great ways as well. Shareholders have to be ready to either step it up and provide additional equity to entertain creditors as you grow, and or accept the consequences. Not willing to put more money in, not willing to bring on additional shareholders to get more money in, chances are really good that you're not going to be able to fulfill your expectations for your business. And I would say, ask Michael Dell, ask Steve Wozniak, ask Steve Raymond, ask the people who have founded big companies today, where they might have been if they didn't bring in additional shareholder equity by having public offerings and selling off ownership of their companies. I think they would all agree they could not have gotten to where they are without doing that. Bank lines of credit, very important for several reasons. One, it's a good example for your creditor community that you have the sophistication and maturity to go out and make those arrangements, to bring in the bank financing, which from time to time will be a necessity to keep those other creditors happy and to support your business growth during times when your cash flow doesn't match up. And specifically in this business arena, technology financing through some of those companies that I talked about, GE, DeLaga Landon, etc., are a great way to go. It's free financing, and they're quick in getting you a response. The applications take 20 minutes or a half an hour to fill out, and you can find a lot of that information on the website that I'm about to give you. And we talked about cash flow, importance of managing cash flow properly, and then in addition to managing it, forecasting it, and do it simply. Don't hire a Harvard MBA to come in and do it for you. That's not necessary. You can handle it yourself and probably do just as good a job about it, but you might need a tool, and I'm happy to provide you one. So this is my contact information. You're certainly welcome to contact me on anything we've talked about today. But let me point you to the bottom line, techdata.com/credit. There's a number on that credit portal page, there's a number of great references for you. You can go in and see our financing options. You can learn more about our leasing partners and our financing partners. And then there's a section about news, it's called News and Hot Topics. And if you pull that section down, in there you'll find a number of white papers that might be of interest to you. but also that cash flow forecasting model is right there, and you can bring it in onto your own computer and use it as you go about the task, become better at managing and forecasting cash flow. So we're at the end of the presentation. We're ending a little bit early. That's just fine. I do appreciate your patience and attendance today. I hope this was worthwhile. Tech Data stands ready to help you with your financing needs. We have a staff of experts that are seasoned in these subjects, and it's our intention not just to be the financing company that says yes or no, but we intend to be someone who is consultative and helpful to you as you manage and grow your business, and providing you the benefit of our experience, some of which I've shared with you today. And again, appreciate your time and attention. Look forward to doing more business. Wish you a happy new year and a very successful 2014. So long.